Chapter 17, Analysis of Financial Statements. In this chapter, we're going to start analyzing the financial statements that we have looked all semester on. We're going to explain the purpose of it and identify exactly how you analyze. We will look at methods such as horizontal analysis and vertical analysis, where horizontal analysis, you're looking at one item over the course of time, and then you have vertical analysis where you're looking at everything and compare it to one certain thing. And then what we're going to spend most of the chapter on is the ratio analysis. Okay, the purpose, the reason why we analyze financial statements is depends on who's using the information. We have both internal and external users. The internal users are the managers, the officers, the board of directors, and the internal auditors. They want to keep track of how the company is doing and make sure that their budget that they have to adhere to stays in place. And the external users are people who do not work for the company, but still have a stake in their success. This would be shareholders, lenders, suppliers. We looked at all of this, the internal and external users of financial statements, back in chapter 1. Now we're just going through this again, but now we actually get to analyze them because we've spent all semester working very hard on this. And what they're looking for when they perform these analysis, the different parts of it, is they want to look at the past and the current performance. They want to see where are they now, but if you know where a company is now, you don't know whether they're better or worse than what they were before. So you always want to also evaluate the past. You want to look at their current financial position and then look at, based on trends, where you see the company next year, 5 years, or 10 years from now. And you'll be able to identify any risk and what risk you're willing to take on. When you perform these ratios and you analyze the financial statements, you usually compare it to something. Just seeing one ratio, like I had said a minute ago, and you can see where they are now, but you don't know if that's better or worse than what they were. So that's why you want to compare it to something. The first thing is intra-company. You want to compare. Let's say one of the first ratios we're going to learn today is the current ratio. Okay, if you see what the current ratio is of a company right now, okay, you know where they stand right now, but are they declining or is it getting better? So you have to look at last year, maybe even the year before. That's intercompany. You're comparing different time periods with the same company. You also want to look at competitors. If you're looking at Walmart, you may also want to look at Target because they are similar companies. You want to see how does one compare to the other. Then you also want to look at the industry as a whole. Take, say, Walmart, for example, and then look at all retail stores similar and come up with an average of all the stores together and see how Walmart compares to the average of everyone in the industry. And then there's also some guidelines that come with this, where in certain industries there's going to be a standard percentage for certain things, and you can set that as a guideline and try to adhere to that same percentage. Okay, and again, we talked about the different types of analysis we're going to do. The first is the horizontal. This compares the financial condition and performance across time. You're looking at one line item over the course of time. Then you have a vertical analysis, which is up and down. So you're comparing the whole thing to one item. For example, with an income statement, everything is usually compared to the net income. What percentage of the net income is it? If you're looking at the balance sheet, it's usually total assets. What percent of assets is this item? Then the last one is the ratio analysis, which you're looking at different parts of the financial statements and you're measuring a percentage or some sort of a factor. Okay, so the first one that we're going to do is horizontal analysis. And here we have the dollar change. If you want to look at, and this is probably the most common one, but you don't really realize what you're doing is a horizontal analysis. You're looking at, okay, what were sales in 2018 and what were sales in 2019? And then you subtract the two, and that tells you how much more you had this year than last year, or how much less you had this year than last year. You just subtract the two numbers, and that's your dollar change. That is the amount that you either increased or decreased from the previous year. Most common, instead of just looking at a dollar change, is look at a percent change. When you just look at dollars, it's harder because maybe for a smaller company the difference is $10,000, but maybe for a larger company the difference between sales from one year to another could be $1 million, and that $1 million to that large company is hardly anything compared to the amount that they actually make. So you want to look at percentages instead. Maybe both companies, one had a change of 10,000, the other one had a change of $1 million. Both changes were actually only 10%. So it is really good to calculate the percent change when you're looking at this. And basically what you're doing is you're going to take the year you're analyzing, which is usually the current year, minus the base period, and then you divide it by the base period. And one way I look at it is the new minus the new number minus the old number over the old. And that's going to give you your percent change. So the current, the new, minus last year, the old, and then you divide it by the last year. And that gives you the percent change, increase or decrease that has happened. Okay, this is an example of a balance sheet. And let's take, I'm going to take inventory. Okay, so we're going to look here at the inventory. The current year is 4,855. The previous year, so the year before, is 2,132. The dollar change in that is 2,723. So that is, that's a significant dollar change. But until you really quantify it in a percentage, you don't really see how much of a change that is. The prior year was a little over 2,000. The current year is almost 5,000. That is a percent change of 127.7%. It more than it increased 127.7%. So you see here that if I just tell you the dollar change is 2,723, it really doesn't mean a whole lot. But once you put a percentage to it, so it increased 127.7%, then you can relate to it a little bit more. So a lot of these analysis that we are going to do in this chapter is percentages, because it's just so easy to explain a percentage rather than just saying the number. Okay, now we're going to do the same thing, but this time we do an income statement. And I would like to look at the net sales. Okay, so we're going to look at net sales. The current year is 229,234. The prior year is $215,639. That's a dollar change of a little over $13,000. And that doesn't mean as much as if I said, hey, the current year net sales has increased by 6.3%. That tells you more than just saying sales increased by 13,595. Okay, then we have trend analysis, which is similar. It's still part of the horizontal analysis. And what you do here to get your percent is you take the analysis period amount, which is usually the current period you're looking at, and you divide it by the base period amount, your starting point. Okay, so let's look at an example. We will see. Yeah, okay. We will start by looking at 4 years ago. Okay, so for net sales, 4 years ago was 170,910. This is going to be our base year. Okay, this is our base year. That's why in trend percentages, you see it's 100%. Because you will take 179.10 and divide it by 179.10, and that's 1 or 100%. Let's look at year 3, 3 years ago. Okay, so that is the year after the base year. The net sales was 182,795, so it increased. But how much? If you take 192,795 and divide it by 170,910, you get down here 107%. So year 3, so 3 years ago, their net sales is 107% of the base year. Another way you can say is it increased 7%. But overall, it's 107% of the previous year. So this is the trend analysis. You can see it went from 107% to 136.7, which increased even more. And this is not 130, it's not 136.7 of the previous year. It is 136.7 of the base year. Everything comes back to the base year. Everything is divided by that base year, the starting year. So you can see from ground zero, from year 1, what have we done? Then 1 year ago was 126.2% of the base year, which decreased from the year before. And then the current year goes back up to 134.1% of the base year. Once you get your percentages, you can put them in a graph, and this is an example of a line graph of a trend percentage. And the green is operating expenses, the red is cost of sales, and then the blue is net sales. And these are percentages, the trend percentages, how much they've increased or decreased. And you can see the current year where operating expenses are on the current year. And then net sales and cost of sales are right there. And you can keep better track. Sometimes a graph, actually, you know how a picture is worth a thousand words? Same thing with the graph. Instead of just, talking about a bunch of numbers, you can show them a graph. And sometimes you don't even have to explain anything, and they can look at the graph and they can come up to their own conclusions about things with very little explanation. Okay, let's do an example of trend analysis. Okay, we're going to look at 5 years, the year 2015 to 2019. And we will look at sales, cost of goods sold, and accounts receivable. Okay, so let's start with sales. I think that's what we're going to start with. Let's see. Yes, we're going to look at net sales, and the base year, remember, is 2015. So we're looking at $150,000 base year. We will take the current year and divide it by the base year. The current year is $282,880 divided by the $150,000, and you get 189%. So the year 2019 is 189% of the base year. The base year will always be 100%. And then let's look at the previous year, which is 2018, divide it by the base year of 2015, and you get 181% of the base year. And then there's 2017, 2016, and then here's 2015. And you notice that 2015 is 100%. Because you're taking 150,000 divided by 150,000, you will get 100% at that point. Okay, let's do this one more time, but this time with the cost of goods sold. Take 2019, which is the year we're looking at, and divide it by the base year of 150,000. And you get 191. And then year 2018, 2017, 2016, and then 2015. And the same thing, when you take the base year divided by the base year, you get 100%. And then I'm just going to put up here what accounts receivable is. It's the same concept. Just take whatever year you're looking at, divide it by the base year, and you will get your trend percentage. You will get the percentage, the percent of increase or decrease from the base year. Okay, now that we've looked at the horizontal analysis, we're going to look at the vertical analysis. This is very common when analyzing financial statements. In fact, most financial statements tend to already have a vertical analysis built into it, and what that is called is common size statements. And we will take the common size percent. So same concept as we just finished talking about. You will take the analysis amount, so whatever you're looking at, whether it's 2019 sales, 2018 accounts receivable, whatever you're looking at, and you divide it by that base amount, multiply by 100, and you get your percentage. Okay, this is an example of a common size balance sheet. When you have a common size balance sheet, you're going to be comparing it with something. You could be comparing January of 2020 to January of 2019. So let's pretend that that's what this is. So let's go back to inventory again, because we already looked at that before. Okay, looking at the inventories. Your current year is 4,855. Your prior year is 2,132. Your common size percent here is 1.3. Where you get that number is with balance sheets, your total assets is your base amount. This is your base that you compare everything to. Your inventory is 1.3% of total assets for, say, 2020, January 2020. For January 2019 was 2,132, which is 0.7% of total assets for that previous year. This is what I'm used to seeing when I was working in accounting for both the balance sheet and the income statement. it was common size, so you can automatically compare. So let's say it's a restaurant. You know what your percentage of inventory should be. Maybe it's food, so you know what your percentage of drinks should be. Your cost for drinks, your cost for meat, your cost for produce. You know that, and you can all compare that with percentages, because usually say 5% is in food cost, or whatever the percentage is. And then on income statements, let's look at cost of sales. We're going to look at cost of sales. The current year cost of sales is $141,048. And our base for income statements is our net income. Take 141,048, divide it by, no, I'm sorry. Net sales. It's not, that is not the base. The base, I'm like, wait a second, that doesn't make any sense. The base is net sales. I am so sorry. Base. The base is net sales. Take 141 divided by the 229 and you get 61.5% for the current year. Cost of sales, which is cost of goods sold, is 61.5% of all the sales. And then the prior year was 131,376. Divide that by the prior year's net sales and you get 60.9%. So the current year, the cost has increased. And one reason why it's really good to look at these percentages is because we see here from the prior year is 131, the current year is 141, so we know it increased. But that doesn't tell you a whole lot. But when you take what percent of cost of goods sales is net sales, that makes more sense, because your cost of sales should increase and decrease proportionately to the net sales, because it's logical that if you increase your sales, you're also going to increase your cost, because you need more employees, you need more items to sell, and so on and so on. Okay, let's look at one more item. Let's look at operating income for 2020. Let's say that's the current year. Okay, operating income is 61,344. Divide that by net sales, because net sales is the base, and you get 26.8%. Operating income is 26.8% of net sales. And at this point, managers are going to have certain percentages that they need to adhere to. And maybe they want operating income to be 40% or 35% or 30%. They can easily go to a common size financial statement to get that. And once you get your percentages, you can just keep them in the financial statements, but for presentation purposes, one thing that you might want to do is put them in a graphs. And usually when you're dealing with percentages, you do a pie graph, but it's not necessary to just stick with one kind. You can see what works. Like in this first one, the pie chart, you can easily see that out of the entire sales, what gets used. 61.5% is the cost of sales. And the next biggest is net income, which is 19.8%. So you can easily get quite a bit of information just from looking at these charts. And you can see the same thing for the bar graph, the bar stacked bar on the right hand side. Cash and cash equivalents is 5% of total assets. Property, plant, and equipment is 9% of total assets. And it's just another way to show the percentages. Okay, let's look at an example of the common size. Okay, here we're given the percentages for the common size percentages for 3 years worth, 17, 18, and 19 for sales, cost of goods sold, and total expenses. We're going to work backwards here to get the number. So we're doing the opposite, backwards. We know that sales is of $100,000 is the base amount. And we also know that 2018 sales is 104.2% of the base year. So take the base amount of 100,000, multiply by 104.2%, and we get 104,200. And then looking at 2018 cost of goods sold is 107.7%. Multiply that by cost of goods sold, the base year of the 59,100. Do the same thing for the total expenses. And then add them up. And then you do the same thing for 2019. You can see that for sales, the base year is 100,000, and multiply that by the 2019 increase. And you get your cost of goods sold and total expenses. Now the rest of this is going to be based on the ratio analysis, and this is what you're going to be doing for your financial statement project. There are 4 different types of ratios: liquidity and efficiency, profitability, solvency, and market prospects. Liquidity and proficiency. Liquidity and efficiency, you're looking to see if the company has sufficient funds or equivalent current assets to pay debts when they come due. It's all about cash flow. Solvency ratios measures the extent to which assets cover commitments for future payments to the liabilities. Profitability, the financial conditions of a corporation. That's where you assess the earnings by a business, and you look at it compared to the activities. And then the last one is market prospects. You compare publicly traded companies, their stock prices, with other financial measures like earnings and dividend rates, and you analyze the stock dividends and the future market value. And this helps decide which company you may want to invest in. Okay, these are just examples of 7 ratios under liquidity and efficiency, and we're going to go through them. First one is the current ratio. The current ratio measures the short-term debt paying ability of the company. You're taking what you currently owe and taking what you currently have as collateral, I guess you could say. So you divide the two, and that's going to tell you whether you are strong, if you have a strong current ratio or not. And if your answer is 1, that basically means you owe $1 and you have $1 to pay. And if it's not have $1, it is you have assets that can turn into cash of $1. If you owe $1 and your current assets are $1.50, that means you can pay all your liabilities and then half again. If you owe $1 and your current assets were 50 cents, then that means you can only pay half of your current liabilities. Next is the acid test ratio, which is basically the current ratio but on steroids. The current ratio is current assets divided by current liabilities. The difference between that and the acid test is you still have a denominator of the current liabilities, but your numerator isn't current assets. It is your cash, short-term investments, and current receivables. Basically, you take the number you would use for the current ratio, but you take out your inventories and you take out your prepaid expenses. Your acid test ratio is always going to be smaller than your current ratio, and it's more stringent. Then we have accounts receivable turnover, which is net sales divided by your average accounts receivable. Now, all of these ratios we've seen before in all of the chapters, but now we're going to bring them all together. So you should know or remember from previous chapters that your net accounts receivable, when it says net and when it says average, you're taking more than one amount. So what you do is you're going to take your beginning accounts receivable as of January 1st. And then you take your ending accounts receivable, which is 12/31. Take your beginning and your ending and you divide it by 2, and that gets your average for the year. And the accounts receivable turnover measures how many times a company converts its receivables into cash. The higher the number, the better. Most of these ratios that you have, you want a higher number. The higher number says that, well, first of all, we know what accounts receivable is. Accounts receivable is a sale that has taken place, but the customer has not paid yet. So it is money promised to you. And the more times you convert it to cash means the more times that you're receiving the money that is due to you. Okay, inventory turnover is next. It is cost of goods sold divided by average inventory. And again, you see the word average. So you're going to take beginning inventory plus ending inventory and divide it by 2. Beginning inventory would be January 1, ending inventory would be 12/31. And this ratio measures how long a company holds inventory before selling it. This is one that you actually want a lower number. You don't want to hold inventory a long time because then you have a higher chance of shrinkage, which is it grows legs and walks away. You have a higher chance of it being broken or outdated or code dates, fashion. It's not the season for it. So you want a lower number because you don't want to hold it very long. You want to sell it quickly. Days sales uncollected. Take accounts receivable net and then divide it by net sales. And then that answer multiply by 365. Because for this, the ratio here measures how frequently a company collects its accounts receivable. This says days sales uncollected. So your answer is going to be in days. That's why you multiply it by 365. Days sales and inventory is similar. It's ending inventory divided by cost of goods sold, and you multiply it by 365. So your answer is in how many days. This is used to measure in evaluating inventory liquidity. The asset turnover measures a company's ability to use its assets to generate sales. And assets could be equipment, vehicles, machinery, buildings, land, all of that. Those are all assets. You don't want a company to just keep buying delivery trucks or land or building unless it's being used to generate revenue. And this is the ratio that shows if the assets that they're purchasing is actually being used to increase revenue. Okay, let's practice some of these ratios. Okay, this is a comparative balance sheet. It is comparative because it has more than 1 year on it. And a lot of times you want, well, all times actually, you don't want to just do one ratio. You want to compare it with something. Okay, so let's first, wait, that was the, yeah, balance sheet. Okay, so the first one we're going to look at is the current ratio. The current ratio is current assets over current liabilities. And let's look at the current year here. The current year total current assets would be these added up. Cash, accounts receivable, merchandise inventory, and prepaid expenses. I'm going to label this CA for current assets. Plant assets are long-term, so they're not included. Current liabilities would be this number, $229,900. Long-term notes payable obviously is not current. Divide the two numbers and you get a current ratio of 1.88. The higher the number, the better. So 2 years ago, it was 2.87. Last year is 2.53. It decreased a little. And this year, it's 1.88. So it's decreasing. Your current ratio is decreasing. And that actually is not a good thing. They still have a pretty good current ratio, but it's decreasing. And because you see a trend, then, 3 points make a line. So 3 ratios make a trend. So because it's increasing, you want to research it. You want to find out, okay, what is different? So let's just take a second to look at that. Current assets increased. Current assets, so they purchased a lot more or they have a lot more cash. But their current liabilities have increased at a higher rate than their assets. So they are adding debt. They're adding more debt than they technically should be, I guess. They could be adding debt because they're purchasing more assets, which is going to give them a lower ratio. Okay, now let's look at the acid test ratio. And we'll look at it for all 3 years. Okay, your bottom number is going to be the same as your current ratio because it's still total current liabilities, the 129.9 for the current year. When we did the current assets, we took cash, accounts receivable, merchandise inventory, and prepaid expenses. But the quick current assets are only the cash and accounts receivable. Inventory and prepaid expenses are not included in the acid test ratio. So that's why you could see the numbers are considerably smaller because we're not including all of the current assets. So if you have less in your numerator, your ratio is going to be smaller as well. Okay, let's look at days sales uncollected. First, we're going to look at the current year and 1 year ago. The accounts receivable for the current year is $89,500 divided by the net sales of $673,500. Multiply that by 365 and you get 48.5, and that's days. So days sales uncollected, they have 48.5 days worth of accounts receivable still uncollected. You want a lower number on this one. And then let's do 1 year ago. 62,500 accounts receivable 1 year ago, divided by the net sales for 1 year ago of 532,000. Multiply by 365, and you should get 42.9 days. So from last year to the current year, they've increased about 6 days, which is not good. Okay, accounts receivable turnover. Accounts receivable turnover is net sales divided by average accounts receivable. Net sales for the current year is $673,500. And then we want to divide it by the average accounts receivable for the current year. And the average accounts receivable is going to be what they started the year with the beginning, and then divide it by, and then add it to the ending, and then divide by 2. Now, accounts receivable right here, this is the current year. This is what they ended the year with. What they started the year with was this, because this is what they ended with a year ago. So what they had on December 31st a year ago is what they started with January 1st of the next year. Add the 2 up, divide by 2, and you get an average of $76,000 for accounts receivable. Then divide those 2 numbers and you get 8.9 times. For accounts receivable turnover, you want a higher number. A higher number says that you are turning over accounts receivable, getting it paid off, new money's coming in, payments are being made. New sales are made, payments are being made. And then let's look at 1 year ago. Sales 1 year ago was $532,000. Starting accounts receivable was $62,500. Actually, it's ending. What they started with that previous year was the $50,200. Divide by 2, and you get 9.4 times. So they are turning over their accounts receivable less in the current year than they did last year, which is not good because you want a higher number. So it is decreasing, and you would want to find out why. Okay, inventory turnover, which is cost of goods sold divided by average inventory. Okay, let's look at the current year. The current year cost of goods sold is $411,225. And you divide it by the average inventory. This is just like the average accounts receivable. You have to take beginning and ending and divide by 2. So for this one, for average inventory, we have the ending the year with 112.5, and they started the year with 82.5. Remember what they started with, they ended with the previous year. And it's 4.2 times. That means they totally turn over their inventory four times and a part of a fifth. And then a year ago would be 345,500. And then you take the 82,500, what they ended the year with, add what they started the year with, which would have been what they ended the year with the previous year, and divide by 2, and it's 5.1 times. So in addition to all the other ratios that have shown a slow in, something is going on, because all of the ratios in the current year are not as good as the previous year. And the same goes for this one. The inventory turnover went from 5.1 times to 4.2 times. And you want to turn over your inventory as much as possible. So this is decreasing. Okay, days sales in inventory. You take the ending inventory, divide by cost of goods sold, and then you multiply by 365. For the current year, ending inventory is 1,012,500. Divide by the cost of goods sold of 411,225. Multiply by 365 in 99.9 days. And then from 1 year ago would be 82,500 and 345,500 to give you 87.99 days. Days sales in inventory. You have 99.9 days this year compared to 87.2 days last year. You're holding more sales in inventory. So your inventory is getting larger, which means the company is not selling as much of their inventory as they should be in comparison to the amount of inventory that they're purchasing. In other words, the warehouse is getting fuller and fuller because they're not selling the items, but yet they're still purchasing it. Solvency is the next section of ratios, and the first one we're going to look at is the debt ratio. The debt ratio is total liabilities over total assets. And then the equity ratio is total equity over total assets. And then we have the debt to equity ratio, which measures what portion of the company's assets are contributed by creditors. A larger debt to equity ratio implies less opportunity to expand through the use of debt financing. The higher the number, the more debt they have. The lower the number, the more equity they're using, which is common stock. Then the last one is the time interest earned. This is income before interest and taxes, and you divide it by the interest expense. This measures a company's ability to pay interest. Okay, let's practice these. Okay, we're back to the same financial statements that we had before. And the first one we're going to calculate is the debt ratio, which is total debt divided by total assets. The total assets is 523,000. The total debt is 129,900 plus the 98,500. Above the line is liabilities. Below the line is the equity. Okay, so the debt ratio is 43.7%. Last year, 1 year ago, the debt ratio was 39.7%. You want a lower number with the debt ratio, as you can clearly see this year, they've increased their debt compared to last year. Okay, let's look at the equity ratio. The equity ratio is total equity, which will be these two numbers added up, 163.5 and 131.1. Add those up to get 294.6 and divide them by the total assets of the $523,000. And you get an equity ratio of 56.3. And then a year ago, the ratio was 60.3. So their equity is going down and their debt is going up. And equity consists of common stock and retained earnings. So common stock is another way to not earn money, but to get money for capital ventures. And then retained earnings is all of the year's net income since the inception of the company. Okay, let's look at, okay, we already did that. The only way you can earn money besides sales is through debt or through equity. If you take the debt ratio plus the equity ratio, you have 100% of the you have 100% of everything. And this just proves that by taking the debt ratio and the equity ratio of the current year, and you end up with 100%. And you can do the same thing for each year, the debt ratio and the equity ratio. Okay, let's look at the debt to equity ratio. Total debt is 228.4, which is again is those two numbers added up, and you divide it by the total equity, which is those two numbers, and you get 77.5%. So they have more. That's just tells you how comfortable lenders would be in taking the risk to increase the company's debt even more. Okay, then the last one here is time, interest, earned. Income before taxes, interest and taxes, is $52,725, and you divide it by the interest expense of $12,100. And you get 4.4 times, and then you do it from 1 year ago, and it's 3.9 times. So the times interest earned is increasing. Okay, the last one now, well, not the last one, the third one is profitability, and let's look at these three. Okay, profit margin we've actually already looked at before. Well, most of these we've already looked at before. Profit margin is net income over net sales, and this measures the company's ability to earn net income for each sales dollar. So if they sell something that's $1, how much of that dollar do they get to keep? That is what the profit margin shows. Then they have return on assets, which is net income divided by total average assets. And this ratio measures how well assets are utilized by the company. Return on common stockholders' equity. Okay, for this one, you take your net income and you subtract preferred dividends. Then you divide by the average common stockholders' equity. Most of the problems that you deal with is not going to have preferred dividends in there, so it's just net income divided by average common stockholders' equity. And this just indicates how the company's ability is to earn income for common stockholders. And because it's return on common stockholders' equity, that's why you subtract the preferred dividends, because preferred dividends get paid first, and we're looking at what will be available after that. Okay, so back to the same financial statements as we had before. And let's look at the profit margin ratio. Profit margin is net income divided by net sales. So net income for the current year is $31,100. And we're going to divide it by net sales, which is $673.5. We come up with a 4.6 profit margin ratio. Out of all of their net sales, what they actually get to keep after everything is said and done is 4.6% of sales. 1 year ago, which would be $29,375 divided by 532 is 5.5. So they get to keep less of their sales this year than what they were able to do last year. Their total asset turnover is net sales of $673.5 divided by average total assets, which would be the 445 plus the 532 and divide by 2. And you get an asset turnover of 1.4 times. And then the previous year would be sales of 532 divided by 377.5 and 445. And that's 1.3 times. Return on assets is net income divided by average total assets. Net income for the current year is $31,100. Average total assets will be 445 plus 523, and you divide by 2. Return on assets is 6.4%, and let's look at the previous year with 7.1%. You want a higher number so you get a higher return on your money from purchasing the assets. The last one is market prospects, price earnings ratio, and dividend yield. The price earnings ratio will be the market price divided by the earnings per share, right? And this measures your market expectations for future growth. The dividend yield, annual cash dividends per share divided by the market price per share. This is used to compare the dividend paying performance of different companies. So not all companies pay dividends, and not all companies pay dividends every year. And this will, if your goal for the investment is to earn dividends, you would want to perform this ratio over the course of time to see what the dividend paying has been with the company that you're potentially looking at. Okay. Return on common stockholders' equity. Take your net income of $31,100 and subtract preferred dividends, and there are none. Divide it by the average common stockholders' equity. and you get 11.1%. Then look at 1 year ago. The net income is $29,375. And then take the average stockholders' equity and divide by 2, and you'll get, 11.5%. So the return on stockholders' equity is also decreasing. So far, just about every ratio is going in the opposite direction that it should be. The market price per share is running $30. It states that in the problem. And then the earnings per share is $1.90. That's going to be stated on the income statement. So the earnings per share ratio is 15.8. And the previous year is 15.6. So their price to earnings ratio is increasing, which isn't a bad thing. And the dividend yield, you take the market price of 29 cents. You take the annual cash dividends per share of 29 cents and you divide it by the market share. And both years are basically the same. So that's a good thing. Okay, this is just a list of all of the ratios that we've gone over and what the formula is and what it is a measure of. This is definitely something that you'll want to have with you in studying for, when you do your homework, studying for the exam, taking the exam, and also working on the financial statement project. Just a little bit about the analysis part of this, I just want to go over briefly. In a traditional analysis, you would have an executive summary, which is a brief analysis of results and conclusions. And this is, it's not called an executive summary, but when you look at the financial statement project, you will want to do this. Okay, after the executive summary, which is kind of like the abstract, it's like just if someone doesn't want to read the whole thing, they can read the executive summary and get the gist of what it's about. Then you have the analysis overview, which you would, if you had to do this, you would do the background of the company, background of the industry, how the industry is doing, and talk about the economy. And the evidential matter, which is the financial statements and the information that you used in your analysis. You'll show your ratios, any trends or comparisons you did. And then you'll also have a list of assumptions, because it's kind of hard to talk about that unless you're actually in it, doing it, but you will have some assumptions you'll have to make. Then you'll list the key factors, list of favorable and unfavorable factors, both quantitative and qualitative. Quantitative is numbers, qualitative is more opinions. And then the last is inferences. You want to look at forecasts, estimates, interpretations, and conclusions. And this is all subjective, because it's based on that person's opinion. Okay, thank you for listening. This concludes chapter 17.